Good afternoon. In this video, we're going to take a look at 3 steps in the accounting cycle. So let's start by reviewing the accounting cycle and see how to proceed. Accounting information system relies on a process which we call the accounting cycle. So the first step in the accounting cycle is analyzing a business transaction. So not all business transactions are accounting transactions. And what we're trying to separate out over here is the ones that qualify as accounting events, therefore they need to be journalized. It goes into the second step of the accounting cycle. So in the first step, we analyze the accounting equation and see if any of those accounts are affected. So let's take a look at the accounting equation. In the accounting equation, in the basic form, we have assets equals liabilities plus owner's equity. So if we have one or more assets, liabilities, or owner's equity affected in a business transaction, then it is an accounting transaction and it needs to be journalized in the general journal. So let's take a look at stockholders' equity and expand that and see what is comprised over here. What do we have here? So revenues minus expenses. Revenues are what the company earns by selling their goods and services. Expenses is cost of doing business. In order to earn those revenues, certain expenses had to be incurred. For a given period, let's say it's a month, the difference between total revenues and total expenses gives you net income. This net income belongs to the owners of the firm. Some of it may be distributed, that is given out to the owners of the business. In a corporation, this distribution is called dividends. So net income minus dividends, that is whatever is not given out as dividends, whatever is remaining becomes a part of retained earnings. So stockholders' equity has two parts: the investment made by owners, that's called the common stock, and the retained earnings of the business. So obviously for a brand new business, the day they start, retained earnings will be zero because there's nothing from the past because there was no past. But subsequently, businesses tend to have retained earnings. The larger the retained earnings, the better off you'd be. So at this stage, our concern is, did the business transaction affect assets, liabilities, owner's equity? And if it did, let's see how we're going to document it in the accounting cycle, in the journal, the next 2 steps. So now we move on to debits and credits. You're looking at 2 sides of each account. So for every account, all the accounts, it doesn't matter which one you're looking at the left-hand side and the right-hand side. The left-hand side is always called debit. The right-hand side is always a credit. It doesn't matter which account you're looking at. The difference is each of these accounts have what we call a normal balance. That's the side we increase the account on. So the easiest to remember is assets. Just keep this in mind. Assets, normal balance is debit. You increase an asset with a debit. You decrease an asset with a credit. The opposite is true on the other side of the equation. For liabilities, normal balance is credit. You increase a liability with a credit. You decrease a liability with a debit. Common stock and retained earnings follow the same pattern, as well as revenues follow the same pattern as liabilities. That is, the normal balance is credit. You increase with a credit. You decrease with a debit. The effect of expenses and dividends, as we saw over here, expenses decreases net income and dividends will decrease that monies that is remaining over here for the shareholders. So expenses and dividends decrease equity. Therefore, their normal balance is debit. You increase them with a debit and you decrease them with a credit. Now, for every journal entry that we do, total debits must be equal to total credits. So with this, let's take a look at an exercise and see how we will apply all this information we just reviewed. So we have an exercise over here with various transactions that have happened. We'll go through each one of these. We've been asked to journalize the transactions. They told us don't provide explanations. Post it into the T accounts, that's a ledger, and then prepare the trial balance at October 31st, 2022. So we've been given all this good information. We will start with the journal. Now, in the journal, let me put the header over here, show you what we have in the header. The first column is for date. Second column is the name, account names. And the last two columns are amounts to be debited and amounts to be credited. So let me quickly recap some accounting rules and then accounting conventions as it relates to journal entries. The first one is every journal entry must have a date. Second is every journal entry must have at least one account debited and at least one account credited. And for every journal entry, total debits must be equal to total credits. These are accounting rules. You must follow them. Accounting softwares will force you to follow them. You don't have to worry about it. They won't let you proceed. We are doing it manually, so we need to remember it, and we are learning this for the first time right now. So we must have a date, at least one account debit, and at least one account credit for every journal entry. Total debits must equal total credits for every journal entry. So let's start by reading the transaction given over here. On October 1st, the business, that is Bayers Corporation, issued common stock in exchange for $66,000 cash from investors. So all the accounting we do is from the viewpoint of the business. That's the business entity concept. We have the date, that's the first thing I'll write down. Cash increased for the business. Cash is an asset, therefore it's going to get debited. Common stock is an equity. That increased for the business. The company issued common stock. So that has to be credited, And the amounts are $66,000 for debit and for credit. So again, October 1st, cash debit because it increased, common stock credit because that increased, and both those are for $66,000. Let's look at the next one. On October 2nd, we hired a part-time security consultant. The salary will be $2,000 per month. First day of work will be October 15th. Now, this is a business transaction. We've signed a contract. We've hired the services of an individual. We've agreed that we're going to pay this person $2,000 per month. But it's not an accounting transaction because at this point of time, it's not affected assets, liabilities, equity. Nothing has been affected. Now, if you are doing this for a company, it would not appear in your financial records, in your books at all. Now, for the purposes of the class, we will write down the date over here, and we will just note that it is not affected by writing no entry for the account to be debited, no entry for account to be credited. That's not an account. We're just writing the words no entry. And in the debit and the credit, we're putting zeros over here. Because the software that we use for our homework purposes wants to know that we have actually read this and understand that no account is affected over here, so we do not debit or credit anything. So this again is an example of a business transaction that is not an accounting transaction. It's not an accounting event. Now on the 4th, we paid 1 month of rent for building for $2,000. Now $2,000 I've paid rent. So first of all, I'll write the date. I paid rent. So cash is credited, cash decreases. So I have to credit cash because it decreases. What did I get? I got the benefit of this building. I got to use the premises. So the account I'm going to debit is called rent expense, and the account I'm going to credit is called cash. And the amount we know is $2,000. So it's rent expense debit. Rent is a cost of doing business. It's an expense. We debit rent expense and we credit cash for $2,000. On the 7th, I purchased equipment for $18,000. Let me write down the date over here first. That's always the first step. I purchased equipment for $18,000. Equipment is an asset. The business acquired an asset. We now own this asset. Therefore, I need to debit it. It increased by $18,000 in my books. And how did I get this? I paid $4,000 in cash. So I'm going to credit cash $4,000. That's how much I paid. Okay. Now, if I stopped over here, this journal entry is incorrect because total debits do not equal to total credits. I'm off by $14,000. What did they tell me if you continue reading? and the balance on account. When you see the word on account, it means it's a credit transaction. I have promised that vendor I will pay them in the future. I will pay them makes it a liability. Accounts payable will be credited for $14,000. So once again, I write the date. I identify the asset that increased. There was an asset that decreased in the same transaction, but not of the equal amount. The rest is the liability. So this is an example of what we would refer to, write that down over here. It's called a compound entry. That means we have more than one debit and or credit within that transaction. The others we have looked at so far are called simple entries. In a simple entry, only one account is debited and only one account is credited. So once again, I'm going to just put these in different colors so we can visually see them a little easier. Okay, so we have the first and the third transactions were simple entries. The fourth one is a compound entry. Let's continue reading. On the 8th, I paid $500 for advertising. I've advertised my business. The advertising agency is going to publicize my business for me. I'm going to get the benefit from it. And it's cost me $500. I paid $500. I parted with cash, so my cash balance decreased. Start with the date, October 8th, and I got the benefit of a service, so it's advertising expense debit. I paid cash, so cash credit, and we know the amount is $500. On the 10th, I received a bill for equipment repair cost of $390. So I purchased that equipment and I got to do some repairs over there. Repairs expense is the account I'm going to debit, not the equipment account. So the account, first of all, let's write our date, October 10th. I paid repairs expense is debit. And did I pay cash for this? It says received a bill for equipment repair. When it says received a bill, it means I've been told I need to pay that money. I have not yet paid it. So again, this is an example of a liability being created in our books. Repair expense debit, accounts payable credit, and the amount was $390. So once again, what we're looking at over here is a simple entry. I got the benefit of a service. I've not paid cash as yet. I will pay in the future, therefore I have a liability. On the 12th, I provided security services for an event for $3,200 on account. I provided services. So this is what I got into business for. I provided security services. I have earned $3,200. Did I get cash? Right now, the answer is no, because it's on account. Now, previously, when it was on account, we had to pay. That's because we got something. Now we gave this our services. We performed services. We will get the money. So this case, it's an asset, and the asset is called accounts receivable. Accounts receivable debit, service revenue credit, and that's for $3,200. So we didn't get cash right now. We will hopefully get that very soon. Okay, so we have billed our client. Just like with repair expense, we got the bill, we received the bill. Now we have billed a client and they're going to send us the money later on. On the 16th, we purchased supplies for $410 on account. Again, the word on account means now I got something, so I will have to pay later on. What did I get? What I got is supplies. Once again, let's start by writing our date. What we got is supplies. Supplies is an asset. And I didn't pay right now. It's accounts payable credit, and the amount is $410. Okay. On the 21st, I paid the balance from the October 7th purchase of the equipment. So on October 7th, I purchased equipment. I owed $14,000. Now I'm telling you that on the 21st, I paid that money. I paid money. The company paid cash. Cash balance goes down, so cash has to get credited. Liability, the $14,000. Once I pay that money, that liability decreases. It should not be in my books, so I will debit the liability. Remember, liabilities, you credit them to increase them. So here you're going to debit it in order to decrease it. In this particular case, since we're going to debit it 14,000, after this particular transaction on the 21st, I no longer have that particular accounts payable in my books. I may have other accounts payable, but to that vendor, I don't owe that vendor any money. I've paid them off. On the 24th, I received and paid a utility bill for $148. So here I got the bill and I paid it immediately. I paid it, which means cash, my asset decreases. Cash has to be credited. I received the bill. I'll receive a bill only when I get something, right? Either I get goods or I get some service. What I got here is service, and the service we're going to call utilities expense. Start with the date, October 24th, utilities expense debit, and we will credit cash because I paid it. And that amount is $148. Okay, now that we have that done, on the 27th, I received payment from a customer, for the October 12th services that I performed. So on October 12th, I had done the work, I performed the security services, I provided my security services at an event, and they owed me $3,200. They're paying me the money now. On the 27th, I received the payment. The business received payment, which means they got cash. Cash increased, cash is an asset, therefore I'll debit the cash. Now, accounts receivable was an asset in my books, but now that asset is no longer there in my books because they paid me. So I'm trading one asset for another. Cash increases by $3,200 and accounts receivable decreases by $3,200. So instead of accounts receivable, I now have cash in my books of $3,200. And finally, on the 31st, I paid employees salaries and wages of $5,100. So on this date, I have October 31st, I'm paying the salaries. So cash is credited. That part is an easy part of the transaction. What should I debit? What did I get in exchange? The employees' services. We call that salaries and wages expense. So salaries and wages expense debit and a cash credit for $5,100. Now we are done with the second step of the accounting cycle. The first step was analysis. We did the analysis and then we did the journal entry. The journal is called the first book because it's the first place where we are going to have an official record of an accounting transaction. So first step in the accounting cycle is analysis. Second step in the accounting cycle is doing the journal entries. We did that. Now we'll move on to the third step, and the third step is posting into our ledgers. Now for the ledger, we have T accounts, which is basically all our accounts, all the accounts that we're going to use. Now, companies have different ways in which they would organize it. Some could organize it alphabetically as they appear, etc. But what is most common is companies will organize their ledgers based on grouping of assets. So let's go back to the accounting equation for that. Typically, if it's in a software, companies will have account numbers that correspond to account names. So what they will do is all the assets will be 100s. So cash will be 101, accounts receivable will be 102, your supplies will be 103, so on and so forth, it'll go down. All your liabilities will be in the 200s. Stockholders' equity, they will have common stock in the 300s, retained earnings 400s, revenues 500s, expenses 600s, dividends 700s. they have a particular pattern. The reason they do this is subsequently it becomes a lot easier as you're grouping them. For our purposes, our textbook tells us that the general ledger, they're going to be organized. You create accounts as they appear. Now, just to make it a little easier, I have grouped them. I have my assets first, and then I have my liabilities and owner's equity accounts that I've listed over here. That's just to make things a little convenient for me as I visually see them. So let's see the process, how it works. Again, the accounting cycle, step one is the business transaction analysis. Step two is journalizing. It's called recording in the general journal or journalizing. Okay. Step three is posting. We are transferring the information from the journal into the ledger. Now, if it's a proper ledger, this is an informal, T account is more informal. But if you're looking at a proper ledger, you need to have the date. So I'll have to have October 1st over here in the cash account. I'll have to put that, but I'm not going to go do that over here. Even in the Value Plus software, they require you to write dates. So I'm not going to write dates, but I just want you to keep in mind that you need to have the date. Okay, so cash is debited. So on the debit side, remember for all accounts, left-hand side is debit, right-hand side is credit. So cash 66,000, and then common stock is going to get credited 66,000. So I'm transferring that information, the 66,000. The second one, which is no entry, I don't need to worry about it. Third is expense, rent expense debit is going to be $2,000. And cash credit is going to be $2,000 on the credit side. Then we have equipment debit, $18,000. So on the debit side, I'll write 18,000. And then we have cash credit. So you see the cash is decreasing now. With each time I put a credit, I post a credit, it means it has decreased. And then I have accounts payable credit, $14,000. Then we have advertising expense debit, cash credit, follows the same pattern. Once you do one of these, doing the rest of them becomes easy. The harder part is doing the journal entry and recognize first which accounts are affected. Did they increase or did they decrease? Okay, I'm going to go ahead and write that over here. So now with the rest of them, you're going to follow the same pattern. So I'm just going to bring all the amounts over here. And I'll do the same for all the other accounts that we have here. I've already done this here, so I'll show you the numbers that I have here. Okay. Now that I have all of this here, I'm done with the third step in the accounting cycle. First step was analyzing the transaction. Second step was doing the journal entries, journalizing. Third step is posting into the ledger. I'm done with that. The next step is going to be to prepare the trial balance. But before I get to that, I need to find the balances at the end of the period. That's the end of the month. Okay, so an easy way to do this is wherever you have only a single entry in over here, just draw a double line under it if you're doing it manually, and you know that's the balance. Okay, so that makes it a lot easier identifying those, which ones we have here that have a balance. And for our expenses, there were only one. Okay. Okay. Now, for the ones that has accounts receivable had one debit and one credit, we take the difference and it's going to be 0. So I'm going to, in this case, it does matter whether you put the 0 on the debit side or the credit side because you're indicating what the normal balance is. So you will always put it on the side that is supposed to have the normal balance, which in this case for an asset gets debit. So on this side, you're going to put that 0 over here. Now for accounts payable and cash, there are more than one debit and one credit for each of these accounts. These accounts have had various transactions happen. So what we need to do is we need to total both the sides. we need to add up both the sides, the debit sides and the credit side, and we take the difference between the two sides, the two totals. Again, put it on the side that is the normal balance. So here we have 14,800 minus 14,000 leaves you with a balance of $800. You will do the same thing for cash over here to arrive at your balance. To arrive at the balance of $43,452. Okay, once again, in the third step, we posted all the journal entries into the ledger. After we are done with that, we need to find the balance in each of the accounts. If you're doing this manually, you can do this visually. It's very easy. All the ones that have only one debit or one credit, just put a double underline under that one number, and that's the account balance. If we have debits and credits that are recorded for any one journal that are posted into a T account, add the sides, two sides, the debit side and the credit side, and take the difference between the two sides, and that gives you the balance. Now, in Wiley Plus, when you do the same exercise, you're not going to write these balances and then find the final balance. You just would find this, you would just write this number. So you skip this in-between step that I have over here, where I added up the debits, added up the credits, and then came up with the balance. You would just come up with the balance if you're doing this on Wiley Plus. Okay. Now that I have all of this information in over here, I'm ready to do the fourth step in the accounting cycle. The fourth step is the trial balance. A trial balance is a document that is prepared just to make sure that total debits have been equal to total credits, and also it's useful in preparing the financial statements. Trial balance is an internal document. It's not shared with any outside party. However, it is considered a formal document. So just like with any other document, we start out with name of the business. Second, we'll identify what the statement is. In this case, it's a trial balance. Third line, we will write down the date on which it's being prepared. Here it's October 31st, 2022. These three lines put together are referred to as the header of the document. And then I have the column headers. I have three columns. The first one is for account name. Second column is for debit, and third column is for credit. Now, if we've done this correctly, this should match what we had in that accounting equation, what I showed you earlier about what the normal balances would be. Now, our textbook tells us that in the trial balance, you're going to list all the accounts in the order in which they appear. So, as I had already organized them, you will see how in what order they are going to appear over here for me, all my accounts. I'm just bringing the account balances over. So I'm just listing them: cash, equipment, accounts receivable, accounts payable. I'll list all of them, okay? And I'm going to mention one thing in a second over here. I'm also going to bring all the balances out over here. These are all the amounts that we had over here. Now, if you look at the account names, look at the general ledger, the T accounts, and then look at my trial balance. Cash, I brought that in. Equipment, I brought that in. I skipped accounts receivable and I came to supplies. So there's a reason why I skipped accounts receivable. The reason I skipped accounts receivable is it has a zero balance. In the trial balance, we will list accounts, only those accounts that have a non-zero balance. So if it has a zero balance, there's no point in bringing it over here. So it has to have a non-zero balance. That's the reason accounts receivable is not listed over here. So once I bring in all my accounts, I now add up the two sides. And when I add up the two sides, the total debits and the total credits, again, assuming that we have done what we were supposed to do all along, everything done correctly, these two numbers that we have here have to be equal. That's the equality that we want to maintain in the accounting, through the accounting equation. Every journal entry, your debits and credits have to stay in balance after every single transaction, okay? So once again, let's review. We analyzed a transaction, we journalized a transaction in the accounting cycle. We analyze a business transaction, we journalize a business transaction, we post it into the T accounts at the ledger, and then we prepared our trial balance. We've done the first 4 steps of the accounting cycle. If a journal entry has more than one debit or more than one credit, as was the case in the third transaction over here on October 7th, it's called a compound entry. If it has only one debit and only one credit, then it's called a simple entry. Another thing I want to mention here real quickly is how we do our posting. It's either called we have one or two options. We can do batch posting, or we can do real-time posting. And I'll explain real quickly what the difference is between the two. What we did was batch posting. We waited until the end of the month, and then we posted all our journal entries in one batch. Real-time posting would be after every individual journal entry, we would post it immediately into the T accounts. We post it immediately into the ledger. With the accounting software, real-time posting is absolutely an option for everyone. It's no big deal. You do your journal entry, it'll automatically go over here. And in fact, it automatically even brings it into the trial balance. So that's not a big deal. When you do it manually, you have a choice how you want to do it. Again, it's up to the accountant how they would want to do it. Depending on the volume of transaction, most companies would prefer batch posting because they don't want to get slowed down by doing 2 steps of the accounting cycle, 2 or 3 steps, when they can wait and do it later, unless it's really important. Okay, so for us right now, you just need to understand the concept of batch posting and real-time posting. For the most part, you're always going to be doing batch posting in this class. So once again, the accounting cycle has many steps. We will look at the other steps in a few other exercises as we go along. Right now, we've just looked at steps 2, 3, and 4. We also did 1, but we actually did in the exercise, it asked us to do steps 2, 3, and 4 of the accounting cycle. So hopefully this is an exercise that helps you better understand the accounting cycle and gets you a good grounding to get started with this class.